Right now, like, millions of people, and maybe even you listening to this, are paying these massive fees to active Wall Street managers. And these managers claim they possess this rare, almost, I don't know, mystical genius for picking stocks.
Yeah, that's definitely the story they sell.
Right. We've all been sold this deeply romanticized narrative of the lone savant. You picture someone sitting in this glass corner office, poring over some obscure financial report at midnight, and having this sudden aha moment about a company that everyone else on the planet has somehow just missed.
Exactly. The whole movie version of Wall Street.
Yeah, we like the idea of investing as this art form driven by gut intuition and sheer intellect. But what if I told you that behind closed doors, like at the highest levels of institutional finance, almost none of it is actually about picking the right stock?
It's really not. I mean, the lone genius narrative is, well, it's a brilliant marketing campaign, right? It sells mutual funds and it sells hedge fund subscriptions.
Hmm.
But you step onto the actual trading floor of an elite institution, and that romantic image just shatters instantly.
It's totally different.
Completely different. The reality of how actual active equity portfolios are constructed, it's governed by strict, unforgiving mathematical constraints,
Hmm.
relentless risk budgets, algorithmic formulas that dictate, like, every single move a manager makes. It's an absolute grind of a machine.
A machine.
Yeah, it's architectural, it's not artistic.
Well, welcome to the deep dive. For you listening, our mission today is to really pull back the curtain on high finance. We're looking under the hood of the exact mechanics, the objective frameworks, and the formulas that true active managers actually use to build portfolios.
It's going to be a fun one.
We're tearing up the myth and looking at the sometimes manipulative math that separates the true masters of the universe from the folks who are just kind of pretending and charging you for it. So, okay, let's unpack this. Before a manager can even begin to think about beating a benchmark, what are the actual fundamental building blocks they're allowed to use? Because clearly, they aren't just throwing darts at a board of ticker symbols.
No, definitely not throwing darts. To understand the building blocks, we have to completely redefine what excess return or active return actually is.
Okay, redefine it how?
Well, most people think excess return means I bought a stock, it went up a lot, so I beat the market.
Right. I bought low and sold high.
Right, but institutional portfolio construction doesn't view the world in absolute stock prices like that. It views the world entirely as this zero-sum game of weights relative to a benchmark.
A game of weights, meaning, okay, so you start with the index, say the S&P 500, and your only job is to decide where to be heavier and where to be lighter.
Precisely. So if the benchmark holds, let's say, 2% of Apple, and you buy Apple so it makes up 3% of your portfolio, you don't really own 3% of Apple in the eyes of the math.
Wait, I don't?
Nope. You own a positive 1% active weight. Your active return is purely driven by that 1% difference.
Oh,
Yeah, if Apple outperforms the benchmark, your 1% bet generates positive active return. But conversely, if you hold 1% of Apple when the benchmark holds 2, you actually have a negative 1% active weight.
so even though I own the stock, I'm technically betting against it.
Exactly. If Apple crashes, you generate positive active return by having been underweight a loser.
Man, so every single decision is just a deviation. You're tethered to the benchmark, and you're just kind of stretching the leash in different directions.
Yes. And there are 3 specific ways you can stretch that leash. We call them the 3 pillars of active return.
Okay, what's the first one?
The first pillar is rewarded factor weightings. This is where you take deliberate, systematic bets on well-known market factors that historically offer a risk premium.
Factors like what?
Things like size, value, or momentum.
Let's ground that for the listener. So if I'm a manager using that first pillar, I'm not necessarily looking for the next hidden tech startup, right? I'm just looking at broad characteristics.
Exactly. You might tell your trading desk, hey, we are going to systematically lean our portfolio heavier into small cap stocks than the benchmark does.
Because history says small caps do well over time.
Right, because decades of financial history suggest small caps eventually outperform large caps. You aren't picking specific small caps because you love their individual business models. You are just harvesting the broad small cap factor premium.
Okay, so pillar 1 is tilting toward known historical factors. What's the second pillar? Because, frankly, the first one sounds too passive to justify a huge active management fee.
Fair point.
Yeah.
The second pillar is alpha skills. Now, this is the pillar that actually aligns with what the public thinks active management is.
The stock picking?
Yeah, well, it involves tactical timing. It's timing those factors, so saying small caps are going to have a terrible quarter, let's rotate into large caps. or rotating through sectors like dumping energy stocks to buy healthcare, or, yes, the classic security selection.
Finding the mispriced stock.
Exactly, finding specific mispriced securities. This is the pure, unadulterated skill of identifying something a market has priced incorrectly right now.
Alpha is the secret sauce. It's the manager saying, the market thinks this company is worth $1 billion, but I know it's worth $2 billion.
That's the one.
But just knowing that isn't enough, which I guess leads to the third pillar, right?
Correct. The third pillar is position sizing. And this is arguably where the most brilliant managers separate themselves from the merely smart ones.
How so?
Position sizing is your willingness to take large, concentrated bets. I mean, you might have a world-class alpha skill. You might have found a company that is absolutely guaranteed to double in price.
But if I only buy a little bit of it.
Exactly. If you only give it a 0.1% active weight in your portfolio, it doesn't matter how right you are, your overall portfolio will barely move.
So you have to put your money where your mouth is. But there's a trap there, isn't there? I mean, if you make the position too big, you stop tracking the market entirely, and you basically tie your entire career to the fate of one random CEO.
That is the trade-off, yeah. Aggressive position sizing drastically increases what we call idiosyncratic risk.
Which is what exactly?
That is the risk tied to that specific company. So, a warehouse fire, a sudden CEO scandal, maybe a failed clinical trial. It's risk that has nothing to do with the broader macroeconomic market risk.
Right, the stuff you can't predict by looking at interest rates. So we have these three pillars. We've got factor tilts, alpha skills, and position sizing. But if I'm an institutional investor, say I'm running a state pension fund, and I'm looking to hire an active manager to handle $5 billion of our money, how do I actually measure if a manager is any good at combining these? I mean, I can't just take their word for it.
Oh, you never take their word for it. You look at their mechanics through the lens of a very specific, almost legendary equation in institutional finance.
Okay, lay it on me.
It's called the fundamental law of active management. This formula is basically the holy grail for understanding where a manager's excess return actually comes from.
Hold on, you're giving me a neat little algebra equation for the stock market, but the market is famously chaotic. It's irrational, driven by human emotion. Does a theoretical formula like this fundamental law actually hold up when a manager is trading real billions in a panic? Or is this just something academics put in textbooks to sound smart?
No, it absolutely holds up because it doesn't try to predict the stock market.
It doesn't.
No, it predicts the manager. The formula deconstructs the architecture of the manager's advantage. The equation states expected active return equals the information coefficient multiplied by the square root of breadth multiplied by active risk multiplied by the transfer coefficient.
Wow. Okay. That is a dense wall of financial jargon.
Yeah.
We really need to dismantle this machine piece by piece so the listener can see the gears turning. Let's start with the first one, the information coefficient. What is an IC?
The information coefficient is the purest distillation of a manager's accuracy. It's a correlation metric.
Okay, so how right they are.
Essentially, yes. When a manager predicts a stock will beat the market, how often are they right and by how much? If their forecasts have zero correlation with reality, their IC is 0. If they are this mythical god who is perfectly right every time, their IC is 1.0.
But nobody is a 1.0.
Right. In reality, a world-class, elite institutional manager might have an IC of 0.05.
Wait, 0.05? That sounds terrible. That sounds like they are basically guessing a coin flip and getting it right, what, 52% of the time?
That is exactly what it is.
You're kidding.
Nope. And in the financial markets, a 52% win rate, if you apply it consistently over billions of dollars, is enough to build a dynasty. You don't need an IC of 0.9 to make billions. You just need a slight mathematical edge over the house.
Okay, so IC is the skill edge, the 52% coin flip. Then we have the second variable in the formula, which was breadth.
Breadth is simply the number of independent, active decisions a manager makes per year.
Just how many times they play the game.
Exactly. If you make 10 independent stock picks a month, your breadth for the year is 120.
Let me try a sports analogy here to make this intuitive. If the information coefficient, the IC, is a baseball player's batting average, showing how skilled they are at hitting the ball, then breadth is just their number of at-bats over the entire season.
That is an excellent way to visualize it. You can have a phenomenal batting average, but if you only step up to the plate twice a year, you aren't going to help the team win the championship. You need at-bats to realize your statistical edge.
Which brings us to the transfer coefficient, the TC. Sticking with the baseball analogy, is the TC whether the coach actually lets the player swing the bat instead of forcing them to bunt?
I love that.
Yeah.
Yes, that analogy holds up perfectly. The transfer coefficient measures how effectively the manager can translate their brilliant insights into actual portfolio positions without being blocked by external rules or constraints.
Give me an example of a blocked swing. Like, how does a manager get forced to bunt?
Let's say your analyst team has a high IC, and they found an incredible opportunity in a specific mid-cap tech stock. They want to make it an 8% weight in the portfolio.
Because they're super confident it's going up.
Right. But the fund's compliance department, or maybe the client's strict mandate, says, hey, you cannot hold more than 5% in any one stock to prevent concentration risk.
Oh.
So your hands are tied. You are forced to cap your brilliant idea at 5%. Your transfer coefficient drops. You are forced to bunt when you really wanted to swing for the fences.
And the final piece of the equation, active risk, that's just how aggressively you are swinging overall, right?
Right.
The total risk you're taking relative to the benchmark.
Exactly. But I want to pull us back to breadth for a second, because there's a profound mathematical reality hiding in the formula there.
Okay, what did I miss?
Notice that I didn't say the expected return is multiplied by breadth. I said it is multiplied by the square root of breadth.
The square root. I caught that, but I didn't want to interrupt. Why does the square root matter so much? It's just math.
It's not just math. It is the physical ceiling of human potential in finance.
Oh.
Seriously. The square root represents the law of diminishing returns. Think about what a manager has to do to scale their business. Let's say a discretionary manager currently makes 100 highly researched independent decisions a year.
Okay.
The square root of 100 is 10. Now, they decide they want to double their competitive advantage. They want to double their alpha.
So they just hire more analysts and make 200
No,
decisions.
no. That is the trap. The square root of 200 is only 14.1. They haven't doubled their multiplier. To get a multiplier of 20, to truly double their original advantage of 10, they need a breadth of 400.
Oh.
They need exponentially more decisions.
Oh, wow. So if I want to double my edge, I have to literally quadruple my workload. I have to hire 4 times as many Harvard MBAs, buy 4 times as much data, and find 4 times as many unique ideas in a market that, frankly, only has so many good ideas to give.
It is brutal. Finding good ideas gets exponentially harder and vastly more expensive the more you try to scale. A human team simply cannot scale from 100 decisions to 10,000 decisions without their information coefficient, their skill, basically collapsing into pure noise.
Wait, if a manager is forced to scale their decisions exponentially just to double their edge, they can't physically do that with human analysts. They'd be forced to use computers to find those thousands of at-bats, which, I mean, completely changes the architecture of the fund, doesn't it?
You've just deduced exactly why quantitative finance took over Wall Street.
The quants.
Yes, quants realized that humans have a naturally high IC, but terrible breadth. Computers, on the other hand, have a very low IC. They aren't as smart as a human reading a nuance at a balance sheet, but they can execute a breadth of millions.
Because they can scan everything at once.
Right, they evaluate thousands of stocks simultaneously every millisecond. The square root of 10 million provides a massive multiplier that more than offsets their lower individual skill.
That is fascinating. So now that we know the raw ingredients, skill, breadth, constraints, and risk, how do managers actually organize themselves to build this machine? Because you can't just walk onto the trading floor and yell, all right, people, let's maximize our information coefficient today.
No, that wouldn't get you very far.
Right. You need a blueprint.
You need a highly structured blueprint. And the architect's blueprint for a portfolio is generally classified on a matrix with 2 main axes. The first axis is how decisions are made, systematic versus discretionary.
Which is essentially rigid rules versus human opinions.
Essentially, yes.
Yes.
Systematic approaches are strictly rules-based. The manager builds a model, feeds it massive data sets, sets the parameters, and then just steps back. The algorithm makes the trades based on historical statistical relationships.
And discretionary.
Discretionary approaches are opinion-driven. This is your classic fundamental analyst. They are flying at the company headquarters, they're interviewing the CEO, analyzing the supply chain, and making a subjective, nuanced judgment call.
Okay, so that's the how. What's the second axis?
The second axis is the what. What exactly are they analyzing? Bottom-up versus top-down. Bottom-up focuses intensely on company-specific factors, looking at a single company's PE ratio, its cash flow, its patent portfolio, its competitive moats.
And top-down?
Top-down completely ignores the individual companies at first. It looks at the macroeconomy. What is the Federal Reserve doing with interest rates? What are the demographic shifts in Southeast Asia? What is the price of crude oil?
So if we cross these axes, we end up with a four-square matrix. I can picture it. On one side, you have a discretionary bottom-up manager. That sounds like the Warren Buffett style, deeply analyzing individual companies, ignoring the macroeconomic noise, and trusting human judgment.
That is the most traditional form of active management, yes. Then you have the systematic bottom-up manager. This is also incredibly common today. This is the realm of the quants we just talked about.
Right, the computer standing the data.
Exactly. They are feeding thousands of individual company financial ratios into an algorithm to systematically rank the entire global stock market from best to worst.
But what about the other side of the matrix? The top-down thinkers. Discretionary top-down makes sense to me. That's a famous macro hedge fund manager like Ray Dalio or George Soros making a massive gut call on the British pound or U.S. interest rates. But what about systematic top-down? Does that exist? I mean, can you program a computer to predict the global economy?
It exists, but it is notoriously difficult and actually quite rare to do well.
Why? If computers are so brilliant at analyzing 10,000 stocks simultaneously, why are they bad at analyzing the macroeconomy? It's all just
Yeah.
data, right?
It goes right back to the math of breadth. Think about the sample size. There are tens of thousands of publicly traded companies, each reporting quarterly earnings for the last 50 years.
That's a lot of data.
It's massive. That provides millions and millions of independent data points for a computer to test and validate its rules against. But how many global macroeconomies are there?
Just one.
Exactly. There is only one global economy.
Oh.
There have only been a handful of major inflation shocks, interest rate cycles, or demographic shifts in modern recorded financial history.
Oh, I see.
It is incredibly hard to build a robust, statistically significant algorithm on such a tiny sample size of macro events. If you try, the algorithm inevitably just memorizes the past, what we call overfitting the data, and then it fails miserably when a new, unprecedented event happens.
That makes total sense. A computer needs thousands of repetitions to learn, and the global economy only plays one game at a time. So once a manager figures out their identity on this matrix, whether they're a bottom-up quant or a discretionary macro guru, they still have to physically build the portfolio. They have to decide what success looks like.
And defining success requires two components, an objective function and constraints. And this brings us to a massive dividing line in finance, one that completely separates retail investors from institutional giants. The difference between absolute and relative frameworks.
Let me jump in here because I think everyday investors, myself included, naturally default to thinking in absolute terms. Like, when I check my retirement account, I just want the total number to go up. My objective function is maximizing total return while minimizing total volatility. If the market drops 20%, but my account only drops 5%, I don't celebrate beating the market. I'm just mad I lost 5%.
And that is a perfectly rational way for an individual to think. Your ultimate risk is running out of money before you die. So in an absolute framework, a manager is trying to maximize the Sharpe ratio, which measures absolute return divided by absolute total volatility. But professional fund managers are almost never allowed to operate in an absolute framework.
They aren't.
No, they are chained to a relative framework.
Why? Why would a client chain them to a relative framework?
Well, imagine you are managing a $100 billion state pension fund. You have liabilities to pay out to retirees every single month for the next 50 years.
Yeah.
You can't just hand $5 billion to a single manager and say, do your best, don't lose it.
Right, that would be insane.
You divide your massive pool of capital into highly specific buckets. You allocate exactly 10% to U.S. large-cap equities, 5% to emerging markets, 10% to bonds. You hire a manager specifically to fill that U.S. large-cap bucket.
Okay, so I'm hiring them to be a very specific puzzle piece in my larger portfolio.
Exactly. If that manager gets scared of a recession, moves all your money into cash, and U.S. stocks end up soaring 30%, they just ruined your entire pension fund's asset allocation model. You didn't hire them to time the market. You hire them to give you U.S. large-cap exposure and hopefully beat it by a few percent.
So their objective function isn't maximizing total return, it's maximizing the information ratio. Their active return above the benchmark divided by their tracking error or active risk.
Precisely. Their biggest fear isn't losing money. If the benchmark drops 20% and they drop 18%, they literally get a bonus because they beat the benchmark. Their true existential risk is deviating too far from the index and being wrong.
Here's where it gets really interesting, though. If we connect this back to our fundamental law formula from earlier, if a manager's absolute prime directive is do not deviate too far from the benchmark, Doesn't that inherently obliterate their transfer coefficient? We said TC is the ability to swing the bat. If the pension board says you must maintain a tracking error of no more than 2%, they are essentially forcing the manager to hold a portfolio that looks, 95% identical to the S&P 500.
You have hit the central agonizing tension of the active management industry right there. It's a paradox. The institutional clients impose strict relative constraints.
Tracking error limits, maximum sector weights, prohibitions on certain types of assets, and they do it to protect themselves.
Right.
They want to ensure the manager doesn't go rogue and destroy the specific asset allocation they paid for.
But by putting those guardrails up, they basically guarantee the manager can never generate massive outperformance. Exactly. Every single constraint, you add chips away at the transfer coefficient. It strangles the manager's ability to express their highest conviction ideas. You're paying for their brilliant alpha skills, but mathematically preventing them from using those skills efficiently.
It's like hiring the greatest race car driver in the world, putting them in a Ferrari, but installing a speed governor that cuts the engine if they go over 65 miles per hour because the pension board is terrified of a crash.
That is a phenomenal analogy. And this exact tension leads to one of the most controversial and, frankly, manipulative behaviors in the entire financial industry.
Which is?
Well, if constraints force a manager to look almost exactly like the benchmark, how do you, the client, know you're actually getting active management? How do we measure if they are truly doing their own thing or just copying the index and charging you a fee?
And that question leads us to the ultimate litmus test: active share versus active risk. These sound like synonyms, but they measure totally different dimensions of a portfolio. Let's break these down, starting with active share.
Active share is purely a measure of holdings. It measures the physical difference in the weights of the stocks in your portfolio versus the weights of the stocks in the benchmark.
Okay, so if the benchmark holds 0% of a random tech startup and you hold 5%, that creates active share.
Yes. It tells you how physically distinct the portfolio's DNA is from the index.
Let's talk about the math behind it, because I want you listening to grasp how this is calculated. The formula is fascinating. It's 1/2 of the sum of the absolute differences in weights. Now, why the 1/2? That seems like an arbitrary fraction just thrown in to complicate things.
It seems arbitrary until you think about the physical mechanics of a portfolio. A portfolio must always sum to exactly 100%. It's a closed system. Let's say your benchmark is a simple index, and you decide you have a massive conviction on Apple. You want to overweight Apple by 1% relative to the benchmark.
Okay, so I buy more Apple. My absolute difference for Apple is plus 1%.
Right. But where did the money come from? You can't just invent cash. If you are 1% overweight Apple, mathematically, you must be 1% underweight something else to pay for it.
Gotcha.
Let's say you sold 1% of Microsoft to fund the Apple purchase.
So my absolute difference for Apple is 1, and my absolute difference for Microsoft is also 1.
Exactly. If you just summed the absolute differences, you would get 2%. But you only made one active bet. You only shifted 1% of your total capital. So the formula divides the sum by 2 to get the true active share of 1%. The 1/2 simply prevents double counting the buy and the sell that are inherently required to make a single active decision.
Okay, that makes perfect sense. So active share is the DNA of the holdings. What is active risk then?
Active risk, which the industry usually calls tracking error, measures the difference in the returns. It doesn't care what stocks you hold, it cares how the portfolio behaves. Specifically, it is the standard deviation or the volatility of the active returns.
So how much it swings.
Yeah, it tells you how wildly the daily or monthly performance of the portfolio swings compared to the performance of the benchmark.
So if I own completely different stocks than the benchmark, but they happen to go up and down by the exact same percentage every day, I have a high active share, but a near zero active risk.
Exactly. And based on these two independent metrics, we can actually map out a spectrum of investing styles. Picture a graph. On the far left, you have pure indexing. Zero active share, zero active risk. You just own the benchmark.
You are a Vanguard S&P 500 ETF.
Right. Then as you move to the right, you have factor neutral funds, then factor diversified funds. As you keep moving right, you start taking concentrated factor bets. And finally, on the far right of the spectrum, you have the concentrated stock picker.
High risk, high reward.
They have massive active share because their portfolio of 15 obscure stocks looks nothing like the index, and massive active risk because their returns are going to deviate wildly from the market.
But there is a villain hiding in the middle of this spectrum, isn't there? The industry calls it the closet indexer.
Yes. The closet indexer is a parasite on the active management industry. This is a mutual fund that advertises itself as an elite, actively managed fund. They charge you a 1.5% management fee every year. But when you look under the hood at their metrics, they have a very low active share and low active risk.
They're just copying the index.
They are effectively mirroring the index, maybe tilting a fraction of a percent here or there, but essentially charging you active fees for passive performance.
They're hiding in the herd. They don't want to take real risk because if they underperform, they get fired. So they hug the index, guarantee they'll perform slightly worse than the index after fees, and just collect their massive paychecks.
Precisely. Now, over the last decade, sophisticated investors and institutional consultants started wising up to this scam. They started demanding to see high active share. They essentially said, if we are paying you an active fee, you must prove your portfolio looks substantially different from the benchmark. We demand high active share.
And this demand creates a profound behavioral loophole because put yourself in the shoes of a portfolio manager who is basically a closet indexer. You are desperate to boost your active share numbers so your marketing department can actually sell the fund. But you are still terrified of taking on actual active risk because you don't have real conviction and you don't want to get fired for blowing up the fund's returns. How do you solve this puzzle?
This is where the mechanics of portfolio construction are actively weaponized against the investor. The manager can use a very specific mathematical trick. Suppose the benchmark contains Home Depot and it makes up 2% of the index.
Okay, Home Depot, massive home improvement retailer.
As the manager, you sell your entire 2% position in Home Depot. Your portfolio is now 2% underweight the benchmark. You take that cash and you buy a 2% weight in Lowe's. Lowe's is Home Depot's biggest competitor. But let's assume, for this example, that Lowe's is not in this specific benchmark index.
Wait, I see where this is going. What happens to the math when you do that?
Your active share shoots up. You just created a 2% absolute difference by dumping Home Depot and another 2% difference by buying Lowe's off benchmark. Divide by 2, and you just artificially generated 2% of pure active share. Your portfolio's holdings now look mathematically very different from the benchmark.
Wait, they can literally just swap them out. But what happens to the active risk? The tracking error?
Almost nothing, because Home Depot and Lowe's are fundamentally identical businesses driven by the exact same macroeconomic forces.
Sure.
Housing starts, consumer spending, interest rates, their stock prices are highly correlated. They move up and down in lockstep. So your portfolio's returns will continue to behave exactly like the benchmark. Your active risk stays completely flat.
Let's just pause and linger on the magnitude of what you just said. Wall Street can literally sell Home Depot to buy Lowe's, change absolutely nothing about the actual economic risk of the portfolio, and yet print a marketing brochure that says, look how high our active share is. We are daring high-conviction active managers. Pay us our 1.5% fee.
It is a perfect illusion. It is compliance engineering at its finest. They are gaming the active share metric to look active while internally keeping the risk profile practically identical to the index so the manager never experiences a career-ending underperformance.
That is maddening. It means active share, as a standalone metric, is completely vulnerable to manipulation. You have to look at both active share and active risk together.
It absolutely must.
Yeah.
Which brings us to the next critical phase of portfolio construction. Because a genuine active manager doesn't just manipulate risk, they have to actually spend it. Risk is not just something that happens to a portfolio. In the institutional world, risk is a currency. It is a strictly budgeted allowance.
I love that framing. Risk as a currency. You have a finite amount of tracking error you're allowed to spend before the client fires you. So how do managers figure out the price tags of their bets? How do they know how much risk they are spending when they buy a stock?
They calculate something called the contribution to active variance, or CAV. This sounds highly technical, but it's actually a beautiful concept. The CAV tells a manager exactly how much a specific active weight in a stock or a sector is contributing to their total tracking error budget.
Okay, but how does it calculate that? What is the math under the hood? Because the source material mentions covariance here, and that's a heavy statistics term. What are we actually talking about when a manager measures covariance?
Covariance is the measurement of how two different assets move together. Think of it like owning two businesses in different cities. If you own an umbrella stand in London and an umbrella stand in Seattle, the revenues cover positively. When it rains in London, it's probably raining in Seattle. If you buy both, you haven't diversified your weather risk, you've doubled it.
Right.
But if you own an umbrella stand in London and a sunscreen stand in Miami, they have negative covariance. The weather patterns offset each other.
So in a portfolio, the contribution to active variance isn't just about how volatile a single stock is on its own.
Exactly. The formula for the contribution to total variance is the weight of the asset multiplied by the covariance of its returns with the entire portfolio's returns. If you buy a highly volatile tech stock, but it moves completely independent of the rest of your portfolio, maybe it has zero covariance with your bank stocks and energy stocks, it actually doesn't cost you very much of your risk budget. It blends in.
Oh, that makes sense.
But if you buy a stock that moves in the exact same direction as 80% of your existing holdings, it costs a massive amount of your risk budget because it magnifies your existing vulnerabilities.
This changes everything about how you build a portfolio. You aren't just ranking your favorite stocks from 1 to 50 and buying them. You have to construct a mosaic where the pieces balance each other's volatility.
Precisely. And depending on their philosophical style, managers spend this risk budget in entirely different ways. Consider the difference between a factor-diversified manager and a sector rotator.
Let's break those down. A factor-diversified manager.
This manager has high breadth. They might hold 400 stocks. They have very low concentration in any single name, so their overall active risk is lower, and the source of their risk is widely dispersed across many small factor bets. They are spending their risk budget in tiny fractional pennies across hundreds of ideas.
Whereas the sector rotator is the complete opposite.
The sector rotator has very low breadth. They might only make meaningful active bets across 5 or 6 major macroeconomic sectors. They have incredibly high concentration, so their active risk is much higher, and the source of their risk is massively driven by those specific chunky sector bets. They're taking their entire risk budget and throwing it down on a few giant hands of poker.
But what happens when a manager, regardless of their style, wants to increase their expected returns, but they've run out of high conviction ideas? They've spent their risk budget, they don't have any more good stocks to buy, but the client demands higher returns. The temptation is to turn to leverage, right? Borrowing money to magnify the bets they already have.
Leverage is the ultimate siren song of finance. It promises to magically magnify your active return, but it introduces a mathematical poison into the portfolio. The leverage trap.
This is a vital concept, and I want to spend time here. Because leverage increases your active return, but it mathematically increases your standard deviation, your volatility. And there is a hidden tipping point where leverage stops helping and actually begins to destroy long-term compounded wealth. Walk us through the arithmetic versus geometric return problem. This is where intuition totally fails most investors.
This is arguably one of the most important mathematical concepts a human being can learn about money. Let's completely ignore leverage for a second and just look at a normal, unleveraged portfolio. Let's say your portfolio drops 2% in year 1 and then rises 2% in year 2.
Okay, simple math. The arithmetic average of those 2 years is exactly 0. -2 + 2 divided by 2 is 0.
Right. But we don't live in an arithmetic world. We live in a geometric compounding world. What is your actual physical wealth? If you start with $100, a 2% drop takes you to $98. A 2% gain on that $98 takes you to $99.96. You lost 4 cents. The geometric return, the compounded reality, is practically flat. You survive the volatility.
Okay, losing 4 cents on $100 over 2 years is basically a rounding error. That makes sense.
Now, let's introduce high volatility, fueled by aggressive leverage. You borrow massive amounts of money to amplify your returns. Let's say your highly leveraged portfolio drops 50% in year 1 and rises 50% in year 2.
Okay, the arithmetic average is still exactly 0. -50 + 50 divided by 2 is 0.
Let's do the geometric math. You start with $100. A 50% drop in year 1 obliterates half your capital. You are down to $50.
And in year 2, I get a massive 50% gain. But wait, 50% of $50 is only $25. So 50 plus 25, I only have $75.
Exactly. You're down 25% of your total wealth. The arithmetic average told you that you broke even at 0%. The geometric reality is that you are ruined. In the formula for geometric return, the standard deviation, the volatility, is squared and subtracted from the return. It creates a massive compounding drag. The higher the volatility you introduce through leverage, the more the geometric return gets violently pulled down away from the arithmetic return.
I like to visualize volatility as digging a hole in the ground. If you take a shovel and dig a hole 50% deep, you can't use a 50% ladder to get out. You're starting from the bottom of the hole. To get from $50 back to your original $100, you don't need a 50% gain. You need a 100% gain just to break even. You have to double your money just to get back to the surface.
That is the exact mathematical terror of volatility drag. It proves mathematically why institutional managers have such strict risk budgets and why leverage is so dangerous. You can have a brilliant information coefficient, you can have massive breadth, but if you take on unchecked leverage, the volatility alone will slowly, silently bleed your compounding to death.
It's terrifying because the math works against you in the background while the arithmetic average lies to your face. But even if a manager perfectly budgets their geometric risks and refuses to use dangerous leverage, there is another silent, invisible killer of returns, one that happens every single time they hit the buy button.
You're talking about the hidden leaks,
Yeah.
implicit costs,
Yeah.
specifically market impact.
Yes. When a retail investor logs into their brokerage app and buys 10 shares of a stock, the market doesn't even blink. But institutions don't buy 10 shares.
No, they don't. Market impact cost is the implicit cost of the price movement caused strictly by the manager executing their trades. When a massive pension fund or a mutual fund decides to take a 2% weight in a small cap stock, they might need to buy 5 million shares. They become the demand.
And because the market is just an auction, if there aren't 5 million shares offered by sellers at the current price, what happens?
The act of buying forces the price higher. The algorithm on the trading desk buys all the shares available at $10. Then it has to reach up and buy the shares offered at $10.05, then $10.10. By the time the manager fills their entire 5 million share order, they might have driven the price up to $11. Their average entry price is ruined. And the exact opposite happens when they try to sell. Their massive sell order crushes the bid, driving the price down before they can exit.
So their very existence alters the environment. What factors make this market impact worse?
The constraints are purely physical. Higher assets under management, or AUM, is the biggest factor. The more money you manage, the larger your orders. Lower market liquidity is the second. If you are trading Apple, which trades tens of millions of shares a day, your impact is small. If you are trading a micro-cap biotech stock, your impact is catastrophic. And the third factor is high portfolio turnover. If your strategy requires you to constantly buy and sell, you are paying this invisible market impact tax over and over again.
This dynamic creates what I think is the most tragic irony in finance, the curse of the successful small cap manager.
It really is a tragedy of scale. Walk us through how you see it.
Okay, imagine a young, hungry portfolio manager. They are an absolute genius at analyzing small, obscure, illiquid companies. They have a massive information coefficient. They start a boutique fund with just $10 million. Because their AUM is so low, they can slip in and out of these small stocks completely undetected. They don't move the price. As a result, they generate massive alpha. They absolutely crush the benchmark for 3 years straight.
And what happens when you crush the benchmark for 3 years?
The institutional consultants notice. They write glowing reports. Suddenly, massive pension funds throw money at this genius. In 12 months, the manager goes from managing $10 million to managing $2 billion.
And the trap snaps shut.
Exactly. The manager finds another brilliant small cap stock trading at $10. The total market cap of the company is only $300 million. The manager wants to take a high conviction 5% position for their new $2 billion fund. That requires buying $100 million worth of stock.
Which is a third of the entire company.
Right. It is like an elephant trying to sneak into a backyard swimming pool without raising the water level.
Yeah.
It is physically impossible. As soon as their trading desk starts buying, the price spikes violently. They ruin their own alpha. Their brilliant insight that the stock was worth $15 doesn't matter because by the time they finish buying, their average cost is $14. They captured almost none of the upside.
This phenomenon directly erodes the first two pillars we talked about: factor weightings and alpha skills. Your IC might be perfect, but your massive size destroys your ability to monetize it.
So what can that successful manager do? If success naturally breeds failure, how do they survive?
The industry provides them with a few incredibly harsh choices. First, they can hard close the fund. They cap their AUM at, say, $500 million and return any new money to investors. But management companies hate doing this because their revenue is based on a percentage of AUM. Turning away billions of dollars means turning away millions in guaranteed personal income.
The incentive to take the money even if it hurts the returns. What else can they do?
They can drift their style. They take the $2 billion and start diversifying into mid-cap or large-cap stocks where there's enough liquidity to hide their trades. But this dilutes their specific small-cap genius. They become a mediocre large-cap manager instead of an elite small-cap manager.
And the clients get mad because that's not what they paid for.
Exactly. The third option is they limit their turnover. They hold stocks for 5 years instead of 1 year, acting on fewer ideas to avoid paying the market impact tax. Or they have to invest millions in cutting-edge algorithmic trading desks, slicing their massive orders into microscopic fractions and dripping them into dark pools over weeks to hide their footprint from high-frequency traders.
It really feels like being a traditional long-only portfolio manager is just an endless series of suffocating handicaps. You're handcuffed by tracking error constraints from the client. Your geometric returns are dragged down by the inescapable math of volatility, and your hard-earned alpha is eaten alive by market impact the more successful you get. Not to mention, you are burdened by what might be the most illogical handicap of all, the zero-weight constraint.
Yeah, the zero-weight constraint. If we're talking about structural flaws in long-only management, this is the fatal flaw. It severely limits a manager's transfer coefficient when they have negative insights.
Let's explain this. Suppose a stock makes up 0.5% of the benchmark. A brilliant fundamental analyst at a long-only fund spends months digging into the company's SEC filings, interviewing suppliers, and realizes the company is an absolute undeniable fraud. The accounting is fake, the debt is crushing, and the company is going to declare bankruptcy next month. The stock is going to zero.
A phenomenal alpha insight.
But because they are a long-only fund, what is the most aggressive bet they can make against this fraud? They can choose to hold 0% of it in their portfolio.
Exactly. Their active weight is limited to negative 0.5%. Even if they're 100% right and the stock goes to zero, the benchmark only drops by 0.5%. The manager only outperforms the benchmark by that tiny fraction. Their brilliant, thesis-driven insight yielded almost no tangible excess return.
Their transfer coefficient is basically zero on the downside. They're mathematically forbidden from fully expressing their negative views. So if we want to know how the absolute elite managers escape these chains, we have to look at the final section of our architectural blueprint, unleashing the shorts.
Short selling is the great equalizer. It completely removes the zero-weight constraint.
For the listener, short selling simply means borrowing shares of a stock you don't own, selling them immediately at today's high price, and promising to buy them back later. If the stock price falls, you buy it back cheap, return the shares, and keep the difference as profit. It allows you to make money when a stock crashes. How do institutional managers integrate this into portfolio construction?
There are a few major structures: long-short funds, long extension funds, like 30 under 30 funds, and equitized market-neutral funds. But what's fascinating here is the fundamental mathematical benefit. Shorting completely rehabilitates the manager's transfer coefficient.
Because they can finally swing the bat on bad companies.
Exactly. Let's go back to your fraud example. The benchmark weight is 0.5%. A long-short manager doesn't just hold zero. They can short the stock aggressively, taking a negative 5% weight in their portfolio. When the stock goes to zero, they capture a massive portfolio-moving alpha return. They are finally able to fully express their negative views with the same magnitude as their positive views.
That immediately doubles their opportunity set. They aren't just looking for the best companies, they can actively hunt the worst companies. But there is a second massive structural benefit to shorting, isn't there? It generates cash.
Yes, the leverage mechanism. When you short sell a stock, you sell it to someone else, which means cash is deposited into your account today. A long-short manager can use that cash from their short positions to go out and buy even more of their absolute best, highest conviction long ideas.
So if I have $100 of client money, I buy $100 of my favorite stocks, then I short $30 of the worst stocks I can find. I receive $30 in cash. I take that cash and buy $30 more of my favorite stocks. I now have $130 of long exposure and $30 of short exposure.
That is the exact definition of a 13/30 long extension fund. You are gearing your portfolio to maximize your best insights on both sides of the ledger simultaneously while maintaining a net market exposure of 100%.
And we also see market-neutral funds taking this to the extreme. They might go 100% long their best ideas and 100% short their worst ideas. Because the long exposure and short exposure are perfectly equal, they cancel each other out. They completely strip away what we call market beta.
That is the purest form of alpha generation.
Yeah.
A true market-neutral fund doesn't care if the S&P 500 goes up 20% or down 20% this year. The macroeconomic forces are completely hedged away. The only thing that dictates their return is whether their long picks performed relatively better than their short picks. They have isolated their pure skill.
But we have to be intellectually honest here. We've talked about how shorting frees the manager from constraints, but we have to highlight the terrifying existential flip side. There are massive drawbacks: high borrowing costs to secure the shares, margin requirements, and the big one, infinite loss potential.
The math of shorting is inherently dangerous.
If I buy a stock long, the absolute worst that can happen is the company goes bankrupt and the stock goes to zero. I lose 100% of my money. It hurts, but the loss is mathematically capped. If I short a stock at $10, there is no mathematical ceiling to how high the price can go. It can go to $50, $100, $500. I can lose 200, 500, 1,000% of my initial investment if the stock experiences a short squeeze.
It is a high-wire act without a net. You are removing the structural constraints that artificially limited your upside, but in doing so, you are also removing the natural boundaries that limited your downside. A single violently wrong short position can literally bankrupt a fund in a matter of days.
Which brings us back fundamentally to why the architecture of portfolio construction is so vital. It really isn't about being a lone genius having a gut feeling about a stock. We have seen today that a well-constructed active equity portfolio is a highly engineered, delicate machine.
It is an exercise in applied mathematics and risk management. It is about efficiently delivering the promised characteristics to the client through managing breadth, optimizing your absolute or relative constraints, strictly budgeting your geometric variance so volatility doesn't bleed you dry, navigating the invisible tax of market impact, and knowing exactly when and how to utilize shorting to unlock your transfer coefficient without blowing up the fund.
And crucially, we also learned about the illusions built into this math, the manipulation of active share. Which brings me to a final thought I want to leave you, the listener, with today. We talked about how substituting a benchmark stock like Home Depot with a highly correlated non-benchmark stock like Lowe's artificially inflates active share without adding any real active risk. We know this mathematical trick exists, and we know Wall Street knows it exists.
It is a systemic reality of the industry.
So, if active share is this easy to manipulate, and everyday investors, pension boards, and retirement funds increasingly rely on this specific metric to justify paying billions in high active management fees, is the financial industry hiding behind a metric that can be perfectly gamed? Next time you look at a mutual fund's marketing materials in your 401k, and they are boldly boasting about their high active share, ask yourself, are they actually taking a real high-conviction stand with your money? Or are they just quietly swapping out identical puzzle pieces behind the scenes to trick the algorithm, look busy, and keep their fees high? We started this deep dive talking about the romantic image of the stock picker versus the mechanical reality of the architect. It turns out sometimes the architecture is designed not just to build returns, but to build an illusion. Thank you for joining us on this deep dive. Keep questioning the mechanics of the world around you, and we will see you next time.